Happy Friday, Eric Bible with the Bible team at Neil Home Loans. It's a good Friday as mortgage interest rates have retreated, albeit slightly, but any move down at this point is a welcome relief. Last week we closed Friday with the 30-year fix sitting right at 7.33%. Today we start at 7.22%. Again, not the rates that we all want, not the rates that we all believe we should be at. But again, we got to start somewhere. And any decline is a welcome relief. And the question becomes why? What drove the decline this week? And it was centered in the all-important inflation data. Wednesday, we received the Consumer Price Index report for the month of August, CPI. And there we saw some very interesting things with inflation. Again, confirming that the Fed's stance and fight against inflation is really working. At first, though, the uptick on the headline number, this is what spooked the market, and this is where there was a lot of kind of conflicting views and interpretations. Headline number undoubtedly rose, went from 3.2% to 3.7%, and initially that spooked the markets. We thought, oh boy, here we go, rates are going higher. Well, no, and here's why. Markets started dissecting it, and the increase in the headline number was solely focused and concentrated in the cost of energy, specifically oil. As we know, consumers, what we're paying at the pump has steadily risen over the last few months. Well, the cost of oil globally has gone up as well, and this is really on the backs of some geopolitical concerns, which I won't get into, but that is what drove the headline number higher. And now, other sectors within the headline number, shelter, food, services, lodging away from home, the list goes on, showed yet again sustained continued declines on a year-over-year basis, which brought the markets back to a level of comfort, which ultimately, again, drove rates lower. So it was a welcome relief. Then we fast forward to the all-important core reading of inflation. Again, as I've advocated in the past and outlined in the past, core rate of inflation is what the Fed is watching. When we continue to discuss and talk about this 2% target on inflation, they're referencing core. Now, core, why it's so important is that it removes the volatile aspect in their weighting for food and energy. And the reason why they remove those items is that the Fed's monetary policy does not reach or have direct impact on what we pay for food and in turn what we pay for energy costs. Is outside geopolitical forces that ultimately dictate what we will pay for, say, wheat, steaks, and gas, and so on and so forth. So they do not control that aspect. They want to focus and maintain price stability on the things that they can control. There we saw very nice moderation from the year-over-year number at 4.7% in the month of July to 4.2% in the month of August. That is what put the nail in the coffin and continued the rally and holding rates at the levels they did. So really this prompts the question leading into next week. September 20th, the Fed will meet for September and give us their decision on what they do with rates really through the end of the year. Market is now almost certain, pretty much certain, I'd say 97% certain, that they will not change rates next week. That's a good thing. We'll take that. What the market is uncertain about, and this is really what's creating and sustaining the volatility, what will Jerome Powell say? Will he acknowledge, and will the committee acknowledge that inflation is coming in line with what they want? Is the labor market showing additional signs of weakness and allowing them to now start having the discussion of, okay, what does the recovery effort look like from what we've done? Time will undoubtedly tell, but again, we're very certain, and again, I've included the link again to the Fed Watch tool, very certain that the Fed will not change rates next week, but we're still uncertain of what Jerome Powell will say. So all eyes on that, and as always, we'll provide those insight and updates next week once we have that information at hand. Another thing, though, that is very, very optimistic is I've included two things. One, the National Housing Survey. This encompasses data from across the United States and As we've seen really through this cycle, buyer sentiment and buyer activity remains very strong. The home is priced correctly. It's selling fast with multiple offers and in a lot of instances over list price. So again, despite mortgage rates doing and being where they are, home activity is remaining strong. And this is also validated. CoreLogic released their July home price figures through the year, and we are now 2.5% in price increases for the year. Far outcry from an all-out housing crash. And again, as I mentioned earlier, this is all on the backs on multi-decade high mortgage interest rates. The narrative that home prices are collapsing, we're in a bubble, oh my gosh, it's the end of the world. Well, home prices have defied all odds. They've continued to rise at an exponential rate. And looking through the end of the year, we're going to see potentially 3.5, possibly even higher if rates go lower. So the narrative continues to be the same. Buyers absolutely need to take advantage. Sellers take advantage of the market now. What happens when rates go lower? If we've seen home prices increase on the backs of high interest rates, what happens when they drop 1%, 2%, 3%, whatever that in number is? It's going to be insane. That is the message we need to continue to convey to our consumers. And if you're struggling with getting this message out, you're having challenges, we're here to support you. As always, make it a wonderful Friday and even better weekend. If there's anything we can help you with, we're here and happy to support. Thanks again.